Record on. Yeah, okay. So we've got a bit of a mix, yeses and nos. It's about half half. That is all good. Regardless, we're going to cover a little bit of the basics and then get stuck in to some of the strategies. So tax planning is a process that some accountants do. At Inspire, it's compulsory for all our clients. We work with business owners, solely business owners, and tax planning is a critical component of working with a client throughout the financial year. Now, the process is basically, or the time it takes place is between March and June each year. So we are literally getting the ball rolling on this process right now, and now is the best time to do something about it, not a week or two before 30 June, over a quick phone call with the accountant. That is definitely not the way to, at least to, without stress, do tax planning. Now, the process is we estimate the profit for not just the business entity itself, but the whole family group, because when we're looking at a client, we can manipulate, usually, and I say manipulate, it sounds negative, but it's totally legal. We can move profit into different entities or people relatively easily. So we want to have a full family picture of the business entities themselves, and also the individuals associated with that family group. So we look at the whole group, even investment income if you've got a rental property or two, salary income if maybe your spouse is working for someone else, not in the business, let's say. So that's all important. Now, as an accounting firm, we will come up with our recommendations for ways that client can save tax, and then we meet to discuss those options. During that meeting is where we talk about the pros and cons, because some of our strategies actually need to deploy cash, and we'll sort of talk about some examples of those as we go on. And not every client wants to do certain things with from a cash perspective. So that's always important. But at the end of the day, the whole purpose is to suggest things and then agree to whatever's going to happen. There's an action plan put in place. And again, there may be time sensitive things to do this side of 30 June to make that happen. And then the idea is that that is carried out. So that's the, I guess at a broad high level, the steps involved with tax planning. Now, an example of that is, let's say we estimate the profit to be 300 grand for the family group. Ballpark the tax at 75. We essentially work to, what sort of strategies can we use with this family group? And then if their tax bill is 50 grand instead of 75, the value of the tax planning process is 25 grand. So that's what we sort of need to keep in mind when we are doing tax planning. And the average tax savings per family group is about $18,000 for our client base. So our goal is to more than pay for our accounting fees with this tax planning season that we're in. And again, I've mentioned earlier that we need to make sure we take action before 30 June, but not the 29th. We need to be working on this stuff and being really planned about what we're doing with tax planning from early on. So we're going to go through some of the strategies that we might consider. One of the first ones is writing off bad debts. Now, I know this might sound like a bit of a lame one, but the rules are you actually have to decide to write off bad debts before 30 June in the financial year to be able to claim them. So technically, sitting down with the accountant to do the tax in September, October, after the year's finished, and saying, oh, we're probably not going to get paid that one or that one, technically, that is actually not able to be going and claimed back in the previous financial year. We need to make those decisions, well before the financial year is complete. So what I'd recommend is the easy way to do that is print your accounts receivable, your debtors, different software programs call it different things, and then just check, is there any old ones that you're unlikely to get paid on? And seeing what we can do to write them off. There is a process, you can ask your bookkeeper or your accountant on how to, formally write those off. But that is one of the things we need to consider. The next one here I want to mention, again, this is sort of a little one, is gift cards under $300. So you can get a tax deduction when you give gift cards to employees, and there are exemptions for from an FBT perspective, fringe benefits tax, if those gifts are under $300 and infrequent, irregular. So, so you may want to consider a gift card, and that does include the business owners if you are employees as well. So just keep that in mind. And again, this one's not going to save bucket loads, but it might be a nice way to get a tax deductible $300 trip to Coles. The next one here is prepayments. Now, this one is a little bit more important to consider this financial year than, let's say, in previous financial years' tax planning, because who's heard of the stage 3 tax cuts? That's been in the news a fair bit. Yeah, I can see a couple of hands. So the stage 3 tax cuts is basically Albo going and changing the original tax cuts that were planning, and we'll talk about that later. But what the tax cuts were, and it's still happening, is that our current tax rates in the 2024 financial year are actually going to go down from next financial year onwards. And so when we think of prepayments, small businesses can deduct expenses when they pay for or when they incur the expense. Now, you're able to prepay up to 12 months worth of expenses as a small business. And let's take rent, for example. You might have a lease that goes for the next few years. It's very common. And usually, you pay your rent month to month. But if you were to prepay in the month of June, if you were to prepay 6 months worth of rent, we're actually able to claim that in the current financial year. Now, this sort of suggestion, again, 6 months worth of rent is probably a fair bit of coin. So we want to make sure the business, maybe you're having a great year from a profit perspective, and you're looking at other ways to potentially reduce your taxable profit, then prepayments are actually one of those ways. Now, if we couple that with the reduced tax rates, if we pay those expenses next financial year, we're actually going to get less of a tax deduction next year than we are if we do it this year. Now, later on, I'll go through the difference there, but it will add up to, depending on how many prepayments you might be considering, it might be a significant amount. Alrighty. Pierre, something I didn't say is feel free to pop questions in the chat box as we go. I'm keeping half an eye there. So if you want to clarify anything or something's sort of popping up, then please feel free to do that. The next one here is cashing up super fund. Now, one of the ways that our clients want to build wealth but also save tax is by contributing money to super. Now, I'll find the slide so we don't have to repeat back. But one of the changes that's happened very recently, here it is superannuation contribution caps are changing on the 1st of July 2024. So currently, we've got $27,500 per financial year to put into super as a tax deduction. Now, that includes the compulsory component of someone's salary, but it can also include personal contributions that business owners do outside of employment income, or the portion of super on employment, and that is going from 27.5 to 30K. Now, why is that relevant now? It's because, I guess, planning for an increase of $2,500. But there are also ways, and again, this is very relevant for business owners who've had a significantly good year this year. You may actually want to, and there's a way that we can actually bring forward the tax deduction of next year's cap into this year. I'm not going to go into the detail on exactly how that happens on the webinar today, but it is possible to contribute next year's cap in the month of June, and we claim it this year, but it counts towards next financial year's cap. And in terms of the other super contribution caps changing, non-concessional contributions, which is basically another way of saying non-tax deductible super contributions, was 110 grand this current financial year, and it's increasing to 120K per year. Often clients do that if they've got excess cash outside super, they want to get in there, or they have an inheritance, they've sold a property and they want to rather invest in outside of super entities, they want to invest through super, which has a lot less tax on on the investment earnings. So yeah, that's another thing to consider. And then there's also a bring forward rule that in 1 year you're able to bring forward your next 3 years of contribution limits, and that is going from 330k to 360k. So it's a fair bit, but yeah, just something to keep in mind when it comes to superannuation, and if that is important to you. Cool. And in terms of cashing up your super fund, what some of our clients do is they wait all year and then chip in their 27.5k each if there's a spouse, and that's what their strategy is. Or some of them pay themselves a salary and chip in the super throughout the year, and then they just pay the top up if they want to max out their super contributions. So it depends on the client and the overall strategy, but cashing up the super fund is exactly that, maximizing your tax deductible super contributions. Okay. Alrighty. So the next one here is EVs and the FBT exemption. So this was I think it's about a year old now, or it was released about a year ago. And the whole idea is that there's an FBT exemption, fringe benefits tax exemption, if you have an electronic vehicle. I'm not sure there's going to be many of us having EVs for the industry that you're in, but if you do, and there's some private use associated with that vehicle, then we can look to make that private use exempt. Now, we've done a bit of a calc, which is actually quite difficult to see on the slide there, but a 77 grand vehicle with an exemption and without, we've just done a comparison, and it's about 11 grand difference when we consider the tax deductions associated with that. So again, it's, if you are interested in EVs and it may have a bit of private use portion for your in your scenario, then it might be something to look at to make sure you're claiming that EV exemption for FBT. Cool. Alrighty. Now, the next one here I want to talk about is the Small Business Skills and Training Boost. It's got a couple of carve-outs here, and we don't often see many clients claiming it. It sounds better than it is another way of saying that. But this one does finish soon. It finishes on the 30th of June, 2024. And what it's for is you get a bonus 20% deduction for expenses relating to training your employees, but the payments must be, so that the eligible payments are actually needing to be paid to essentially an RTO, registered training organisation. So if you're needing to do training for your team, you may want to do it this side of the financial year, pay that bill, get the training done, and then you get that extra 20% tax deduction as well. So yeah, it must be an RTO. Employee must be in Australia, and yeah, before 30 June that runs out, and it's actually included in a special box on the tax return. Now, the other thing I usually mention when I'm talking about tax planning, but I haven't yet, is that I would never recommend a business just spend money for the sole purpose of saving tax. When we're thinking of things like doing training like this, just because you get a 20% extra deduction doesn't mean that you should do it. How I would approach this decision-making process is, if your business genuinely needs training or any expenses that we're talking about here, then it's the timing of that expense that might make a difference between 20% extra versus not, or the tax deduction or not. But I sort of recommend to clients, never make a decision to go and spend money. Even traders think to themselves, oh, I'm just going to go and buy a ute to save tax. Well, if you didn't need the ute, you're spending 70 grand to maybe save 20 grand in tax. You still got to find 50 grand out of your pocket. So yeah, I hope that message sort of sounds pretty clear. We just don't want to go and make decisions to sole purpose of dropping our tax. Alrighty. Now, the next one here is the Small Business Energy Incentive. So this is a new one, and it's sort of in and out in this financial year. And it's basically a 20% extra tax deduction for expenses that businesses have on electrification and more efficient use of energy. So what they're aiming for here, and I was trying to see how we could apply that here, is, we've got a fridge in the office, and if we upgrade it to a more energy efficient model, then we could claim it under this energy incentive. So the examples the ATO give on their website is heating and cooling and upgrades to appliances. I'm fairly certain there's even solar systems. If you're looking to chuck solar panels, but again, Chris has asked solar for the factory. I am fairly certain we want to make sure we double check the fine print there. The other thing that I find really frustrating is that this isn't law yet, and the financial year is about to end. Now, I think what happens with these incentives and changes is they usually announce them, and then it's just the process of Parliament approving them. So I don't expect that they're going to be knocked out. Especially when almost 9 months of the financial year has finished, and people will likely have made decisions around this. But this may be something you want to look into. Chris, for the solar on the factory. But if you're thinking of, let's say, and the thought did cross my mind at home here. I've got a home office. What if I chuck solar on the roof? Unless it's business purposes, we can't. We can't look to claim that. Alrighty. Now, just sort of. Some of these are recent changes, but there's a few more I think we should cover. This next one is a little bit of bad news for people who have used trusts before to spread income throughout their extended family. So do many of us use trusts for their in their structure, whether it's the business that's a trust, or maybe you run your business through a company that is owned by a trust? Is there a bit of a feel free to pop it in the chat box. So Tim's got no. Got a couple of yeses. Yeah, cool. So trusts are really handy, and we absolutely recommend them. There's just additional rules that have been brought in the past. Well, I might clarify. There's no additional rules. The ATO have just changed their mind or perspective on decades-old legislation, and unfortunately, it's pissing accountants off and business owners who've used trusts how they normally have for decades. So what the legislation is aiming to do is stop the situation where a trust distributes to, let's say, the main business owner and their spouse. That's fine. That's not what these rules are going after. But they're going after, hey, I'm going to distribute 50 grand to my retired mum, 50 grand to my retired dad, and they're going to pay not much tax on that. Now, that's also not the problem. The problem is never actually intending to pay that 50 grand to each of them. So what the ATO wants is that if you distribute to people or entities, then the cash needs to make it to those entities or people. So it was very normal previously, before they clarified this stance, to distribute on paper but never pay the cash. For ages, Inspire has been saying this is something that's going to be, looked into, and it turned out to be that way. But we've been telling our clients for years before this, make sure if you're going to transfer or distribute from your trust to any other person in your family group apart from you and your spouse, make sure it goes into a bank account in that person's name. And the other thing that this very much deals with is, yes, it's all well and good to go and transfer the 50 grand in, but if they just flick it back to you or buy you 50 grand worth of holidays, that reimbursement is caught under these rules. So we need to be very careful with trust distributions. Now, how that's playing out when we are working with our clients is it's definitely not news that we want to hear. And so what I want to sort of share is, if your accountant is saying to you, well, hang on, we can't do that anymore, then I'm agreeing with that. We need to be quite careful. If we're doing things like the paper distributions, but not paying the cash. I hope that sort of makes that clear. So the examples, the ATO in their clarification of their stance. They gave a number of examples, things like paying the school fees when the kids are under 18. It doesn't really count. Adult children, that's another common one because over 18, children can get trust distributions and get taxed as adults. We can't distribute without paying the cash to them. Parents or in-laws, another common scenario. We just need to make sure they end up with the cash, if that makes sense. Otherwise, we can't do it. Alrighty. I'm not sure exactly how this is going to play out. The ATO have essentially changed their minds, changed decades of precedents of how things have been working. It's very much being challenged by accounting associations and quite a few different people who are negatively impacted by this. So anyway, we'll see how that pans out. But this is what we've been instructed, and the ATO's view. Anything outside of that, you risk potential bad consequences. Alrighty. Now, the next one I want to talk about is the stage 3 tax cuts. Thanks to Elbow. But basically, there was tax cuts in place, and good old Anthony has said, well, we're not going to do exactly that. We're going to do some of it and curve off some of the if you're earning over 150K, I think it is, you're not going to get anywhere near as good of a deal. So we did a bit of a table for our clients just to, I guess, understand how this might impact them, but their taxable income, and this is an individual taxable income level. We've got the old stage 3, what was announced, and then the new stage 3 tax cuts. So as you can see, green means it's a better outcome. So even if you're earning 100K yourself or 100K you and you and your spouse, you're actually going to be $1,600 or so better off under the changes. But it's where we start hitting 150K or more. That's when we aren't better off. At the end of the day, our magic number that we target for our clients' taxable income, at least personally, is about 120 grand for the business owner and their spouse. And so, if the family group is earning more than that, 120K, let's say times by 2, then we might look to leave a bit of profit in a company, for instance. Now, if that's the case, then the client group is actually better off under these changes. And the other thing I wanted to compare the next year's tax rates to, which is down the bottom here, is to what are the current rates right now? Now, the monitor I'm looking at is a bit small, but can everyone read those rates fine? Very good. I think if Zoom is full screen, it might help quite a bit. So the current financial year, the first 18 grand or so, there's no tax, and that's the exact same situation. But we can see a difference in this income band here, the 18 to 45 grand mark, where we're currently paying 19 cents in the dollar, and this is 16 cents in the dollar moving forward from July onwards. So there's a difference there. And then the next difference is this band or threshold from 45K to 120 is moving from 45 to 130K from July onwards. And the tax rate associated with it is 32.5% now, going down to 30 cents. The 37% and the 45% tax rate is staying the same percent, but the threshold is slightly changing from 120, starting at 120 to 130, and then the over 180K threshold is now over 190K threshold. So how does that change what we do as accountants? I mentioned that the 120K is sort of our magic number for taxable income we like to aim for. The reason why is currently that's when your tax rate goes from 32.5% to 37%. Next year, our magic number might look like 135K each, because we're looking from a 30% tax rate to a 37% there. So there's a 7% difference, not another 4.5-ish%. So it's a more considerable difference. Now, earlier I was talking about prepayments. So I said the tax rates are going down next financial year. So you may want to consider paying for stuff this year that you already know you're going to pay for and getting a tax deduction this year. Now, one of those benefits is, and there's more than this, the difference in the tax rates. So ballpark 2.5% for most business owners. Now, the difference there is this 32.5% versus 30 cents in the dollar. So the example I've given is, if you have 10 grand rent paid in June that you usually pay in July for the month of July, you pay it a month earlier, you're going to be probably $250 better off. Just the timing of that. So I'm not sure what sort of things in your business you can consider prepaying. I wouldn't necessarily recommend prepaying the next 12 months worth of everything. The other thing you need to keep in mind, and this is why tax planning, the process is so important, is what's your estimated taxable income right now before you do any of this? And it's important to know that so we can work out what your tax outcome is likely to be. For instance, if you've got a lot, like let's say you've had a little bit of a bad year, then you might not have as big a tax bill as you thought you might have, which means if you go and prepay all this stuff, it might not have such a significant effect. So the key is in the planning part of tax planning, and making sure you know what your current situation is looking like at the moment versus what we might be able to make it to. Now, the other benefit of those prepayments is the time value of money. So if we prepay something this financial year versus pay it in next financial year, we get the tax deduction in this current one, which means we get the benefit of that tax deduction a year earlier than we otherwise would. And when you look at the compound, like let's say you work out whether it's 10 to the tax impact on 10 to 50 grand, or maybe even 100 grand of prepayments or tax saving strategies that you get this year instead of next, it might actually be a considerable amount of money. That might look like 37 grand worth of tax that you're pushing out to a year later. And what could you do with that in the meantime? Could you buy stock? Could you invest it? All that sort of stuff. And what we often do with our clients is, the question might be, well, hang on, aren't we just pushing the tax bill to next year and we'll pay it anyway? But the whole idea is we do that every year. We just keep pushing it down the line and using that time value of money in the meantime. So, yes, technically we are pushing it to next year, but let's continue that strategy so that we're getting that impact every single financial year. Alrighty. Now, the next one I do want to talk about is depreciation changes. So, so the immediate write-off was actually removed about 8.5 months ago. So on the 30th of June last financial year, and for the short period before that, we had an unlimited amount we could write off for depreciation purposes. So we could buy $1 million truck and so long as it's business use, write the whole thing off on a tax bill. Now you're limited to assets costing you 20K or less, excluding GST. So it is a huge difference. And this is sort of back to how the rules were before COVID. Before COVID, the most recent one before that was 30 grand limit. Now it's down to 20. So again, if you're thinking, if your previous tax planning strategy has been, I'm going to go buy a 50K ute, that won't work this year. For assets costing more than 20 grand, we need to write them off 15% in the first year, 15% of their value in the first year, and 30% every year after that of the remaining value. So they're the sort of old school rules. I say old school, it was just 2019 and previous. And accountants have had it easy doing depreciation schedules for the last few years. Now we're going to have to do some work to calculate those percentages. But again, just keep in mind that 20K threshold. So you want to upgrade the laptop or a computer, or you get a single cab ute, maybe second hand might get charged to 20K. Things like that might be under that 20K limit. But yeah, just be mindful that we don't have the beauty of an unlimited threshold anymore. And the other impact I feel like this is going to have on clients generally is, like, I was looking at a client the other day, and they had like 40 grand in taxable profit. Not much at all compared to what I thought their business was doing. And I just looked into the financials and I saw about $550,000 worth of depreciation. And they just bought a truck, and they're in tree lopping and mulching. So they had a mulcher and a truck that they bought for just over $500,000. And that brought their depreciation much lower. Now, because of that unlimited, the no cap depreciation that we had last year. So the impact on that business is they would pay next to no tax last financial year, but this financial year, if they do the same performance business wise, which was about 600 grand profit before depreciation, then they're going to pay a lot more tax because they don't have that depreciation. So the other thing I want our clients to be aware of is, hey, we might have had it good for the last few years because of depreciation, but now these are changed. Yes, you might have bought assets this year, but we just can't get the same benefits that we used to. So yeah, the news might be a bigger tax bill, but I feel like knowing what it's going to be is better than not knowing and not really having a plan until the accountant does the tax returns and then you hit with a bill. So yeah, the message here is you may be paying more tax generally this year and moving forward as a result of that. Okay. My next slide was super contributions, which I did talk about earlier. So I talked about the rate going from 27.5 to 30. And that actually means we've hit all the content I wanted to share. And now we can switch into question and answer. So if you've got a question and you're happy to sort of, like, I'm happy to do it either in the chat box, or because we're a Zoom meeting, not a Zoom webinar, you can take yourself off mute if you want to have a chat to me. And yeah, basically open for questions. And while you might be having a think about questions, if you do have a question that you want to run one-to-one with our team, or you want to consider what working with Inspire looks like as an accounting firm, then feel free to book in for a strategy call with one of our accountants. Now, we are a referral-only accounting firm, which means that there is a question when you book in a strategy call of who referred you, and make sure you just write SPASA, just so we know where you've come from. We actually turn away people. We had someone write in a full stop in that answer today, and we said, oh no, we need to go and, we're referral only for a reason, and the reason for that is because we've only got a certain amount of capacity to take on new clients, and we've preferenced that to clients who refer to us, or even associations such as SPASA, who have members that they might want to get our help with. So yeah, that's the next step if you do want to have a chat to our team about what it looks like. And again, if tax planning is a consideration that you want our help with, let's say your accountant doesn't offer it, for instance, then I wouldn't leave this until May or June. Get on the front foot, at least have a chat to see where we're at, and if it might be helpful for you. So jumping back to Q&A, I actually haven't seen any questions. So, does that mean everyone's fairly sorted, cover the content well? Maybe. Tough crowd. Okay, thanks, Chris. Nikita has asked, how many years can you make up with super? Okay, so there is a rule with super contributions for catching up on previous years that you didn't max out your contribution. Now, one of the eligibility requirements is that you have to have a current super balance of $500,000 or less. to do the catch up thing. And the catch up goes back 5 financial years. So let's say last year you popped in 20 grand instead of 27 and a half. That's 7.5 grand we can catch up on this financial year. So the other thing to be mindful of is if you go over your cap, then you pay excess contributions tax, and it's costly and defeats the purpose of the tax deduction thought process of putting money into super. So there is a report that we can get as accountants to look at what your super contributions have been for, let's say, the last 5 years, and to guide you on how much your unused cap is. Let's say you've put no super in the last 5 years. That's literally 27.5 grand a year times by 5, and you can do that in one hit. It's perfect for business owners that have had a really good year and they want a large tax deduction. Get money into super and invest it through that way. So I hope that helps, Nikita. Timothy Richards, how does writing off bad debts work? So I'll answer this one here, and I'll pop my slide back. So with bad debts, this was sort of towards the start of the webinar. The whole process of bad debts is we have to write them off in the financial year to claim them as a tax deduction in this financial year. So you might know from the top of your mind who owes your money, who you might not likely get paid on, but the place to find it is in your, let's say, your Xero file or whatever software you use. It'll be your accounts receivable report or your debtors report, and that will show you all the people who owe you money per your accounting file. And what you need to do is go through, especially the older ones, to just double check, are you going to get paid on them or not? Have you followed them up that you're likely not going to get paid? Yeah, that's the process of writing off bad debts and getting them as a tax deduction. Next question here, Celeste. Can we put my husband's contribution into mine as a spouse contribution and just do the minimum in his? I'm kind of not sure where that one's going. Hopefully I answer it this way. So basically with super contributions, where we've got a business, let's say it's run in a company or a trust, but we've got a husband and wife who runs the business, we would consider both of their super contribution caps and how we can get money from that company or trust into their personal names and then as a deduction into super. So there are ways to do that. I mean, just sort of a little bit hard to sort of see exactly what you're looking to do there. And sometimes we can put money into one of the names and not others, and that's totally fine. But what we want to do is make sure that you don't have, where you've got spouses, you don't want to have one person in the huge tax bracket while the other person's in like the 20 grand tax bracket. It's not great if we can avoid that. There are certain instances where there's no legal way around that. So so if you've got a trust structure, then you should be good to go in terms of again, with the planning and doing the contributions right, to contribute with whatever way, whether it's your super fund or your husband's. Greg, we have a small pool maintenance business. My husband pays himself. I do a lot of work, and we were told by accountant who only does our end of year taxes that there is no benefit to me getting paid. Is this true? Probably not. Is me shooting from the hip. Again, if your only income is from getting paid from this business, then you've got your 20 grand tax-free threshold that we can, allocate 20 grand worth of salary or wages to you, and you'll pay no tax on that. So again, what I can't see is the full picture here, but it doesn't sound right. If you're working full time, earning 120 grand for someone else, and doing a bit for your husband's business on the side, that might be the context I don't have. That I go, no, okay, I can see you shaking your head. Okay, so I definitely get that looked at. Alrighty, Nikita, does that mean if a bad debt accumulates from June, it may not already be overdue until the following FY? Yes, that's right. Sorry, I got a tickle in the throat. So if you raise an invoice in June, your terms are 60 days. They don't pay in August or July, and you think it's going to go bad, we can't go and write that off back to 30 June. That's the way the rules are written. Cool. Alrighty. I think that is all the questions so far. And Gemma, I think it was your question. So yeah, you just reminded me. So one of the services that we offer is what we call a look under the hood, which is a second opinion on if you're paying too much tax. So situations like that is perfect for it, where it's a paid service of ours, that we look at what the accountant's prepared, and we overlay any tax saving strategies that we could have done if we were advising you, and most times there's a difference in the outcome they've got, and what we can do for you. So that process may be valuable, and if you want to talk more about that, then that strategy call, or the initial chat link, which was posted earlier, is probably the best place for that. Awesome. Alrighty. Well, hey, I can't see any more questions popping in. I hope that's been helpful for everyone. And again, a big thanks to SPASA for hosting us on today. Thanks, Chris. Again, impressive pool. That is a very white and nice blue clear water. My pool does not look like that. Oh dear. All right.
I'll
Thanks,
just quickly jump in.
Oh, yes.
Thank you for that, Ben. That was informative. Hopefully everyone got something out of it. And like you already said, jump in and book your strategy call, because Inspire have been a really supportive partner, and they obviously have a lot to offer. So go and utilize their skills. So thanks again.
Yeah, fantastic. Thanks, Kita. All right, and thanks everyone for interacting. I definitely love um, the workshops where there's real help I can assist people with. All righty. Well, thanks again, everyone, and appreciate it.
Thanks, Ben. Thanks, guys.
Cheers.